Let's tackle a huge question. Can you actually beat the stock market, or is it a fool's game?
Well, let's look at a real-life mystery that puts that exact question to the test.
Okay, so there was this hedge fund called Integral. It seemed perfect, promising safe, steady returns.
It looked so good, in fact, that the Art Institute of Chicago poured in $43 million.
A few years later, though, that whole investment was gone. Poof, worth basically zero.
So how does something that looks so safe turn out to be so dangerous? Let's dig in.
The main culprit here is a really powerful idea called the efficient markets hypothesis. The basic idea? You can't beat the market because all the available info is already baked into the price. And hey, this race for an edge is nothing new. From carrier pigeons to fiber optics, it's always existed.
People knew this even way back in 1889. They saw prices as a collective judgment on a company's value.
Then in the 60s, Eugene Fama's research suggested most professional stock pickers weren't skilled, just lucky.
Right, so if the market's so smart, how did Integral fake being so successful for so long?
Well, investors use this thing called the Sharpe ratio. It's supposed to measure performance, but it can be tricked.
Here's how. You make a portfolio that looks great on the surface by hiding a massive, ticking time bomb.
And that's exactly what Integral did. It was an illusion of safety, but the risk was always there, just hidden.
So there's a better way to think about how markets actually work. It's a fantastic analogy.
So which is it? Are prices just random, or do they always come back to some true underlying value?
Economist Robert Shiller came up with a great way to think about this. Picture a drunk and a lamppost.
See, the lamppost is the company's real value. The drunk wandering around, that's the daily market price.
The market might wander off for a long time, but eventually, that leash gently pulls it back to reality. Okay, so what's the takeaway from all this? What really matters when you're thinking about investing?
It means that the efficient markets theory isn't totally wrong, but it's only a half-truth, a dangerous one. So remember, be really skeptical of too-good-to-be-true returns. Character matters more than stats.
Because at the end of the day, numbers can lie. The real question is, who are you putting your trust in?